firm, along with a group of investors, has taken a substantial position in the stock and is calling for major changes to the board. Jonathan Duskin is the CEO of Macellum Advisors. He's with us live today for an exclusive interview. It's good to see you. Welcome.
Thanks so much for having me, Scott. Good to see you as well.
It's a big stake. You have a big letter, too, as these things go, 25 pages or so. There are a lot of retailers out there, a lot of retailers whose stock is not up 100% in 3 months. Why Kohls?
Well, actually, if you were to look at Kohls' performance, kind of pre-pandemic and off the lows, off the COVID lows, it actually is materially underperformed. If you look at the XRT, something that we use as a proxy to talk about retail, the XRT is up over 70%, and Kohls is, barely up 10%. So, despite having rallied, if you look at most of retail, it's really rallied. And, we're really concerned with the period kind of before Kohls, the decade or two leading up to, before COVID, the decade or two leading up to that. So the fact it's had a nice bounce off the COVID lows, we're not terribly impressed by. It's still underperforming. It still has one of the lowest valuations in the sector.
So let's talk about what you want. You want 9 seats on the board. That's a lot of seats. So effectively, you want control of the board. I should also let you know that just moments ago, literally, we got a new statement from Kohls regarding what you're trying to do. And I'm going to read that and get your reaction to it. They say, quote, "We reject the investor group's attempt to seize control of our board and disrupt our momentum, especially considering that we are well underway in implementing a strong growth strategy and accelerating our performance. And we have refreshed half our board with 6 new independent directors since 2016. We mentioned the stock performance, and sure, a lot of retailers have gotten a bump since the bottom. But this company has laid out a plan. The stock seems to be performing. A lot of analysts have upgraded it. Why not let it go? Why not let the company and the board and the CEO figure it out and turn the ship?
Well, Scott, let me try it a couple ways to answer that. First, take a guess what the stock price was in February of 2001. It was $50. 20 years, the stock has done nothing. The last decade, the stock has done nothing. Sales have been flat to down. EBIT is down 44%. It's dramatically underperformed its peer groups, whether it's the XRT or the proxy peer groups or the ISS peer groups and other retailers. It's really dramatically underperformed. When you talk about their new plan, we're often reminded of their greatness agenda that they launched in 2014. And, to us, it's symptomatic of their inability to execute the plan that they lay out. In 2014, in the greatness agenda, they talked about $21 billion in sales, $1.9 billion in EBIT. And for 2017, they missed that by 25%. And by the end of 2019, they'd missed those objectives by 36%. So in our mind, it's really about their inability to execute the initiatives that they set for themselves. It's also about the lack of expertise in the boardroom. You talked about 9 might be a lot of directors. They don't have one single retail CEO on their board. Big box, small box, on-mall, off-mall, not one, not hard goods or soft goods. It's really amazing to think that a company would be able to succeed with that kind of board with no retail expertise in the boardroom. It's kind of shocking to us that they are not more willing to embrace the directors that we put forward. We put some incredible candidates forward. So we're actually surprised that they're not embracing our opportunity, our offer to help. We really do just want to fix this business. It's a good company. It could be a great company.
Now, Cramer spoke highly of the slate. He did that earlier today. Are you willing to settle for less than 9?
Look, we always want to work constructively with boards. We've been talking to the company since December. We've had multiple calls with their board and several directors. And, we would like to work constructively. The fastest way, the quickest path to create value for all shareholders is if we can work together. But there needs to be significant change. We nominated 9 directors because of the severity of the situation and the urgency that's needed. And we really think significant change is warranted. If we can work with the board and work constructively and get to a kind of common understanding of what needs to be accomplished, I think we would be willing to have those conversations. Dragging this out in a public forum is not the best way to do that. So we would welcome further discussions, but we're obviously happy to run this out all the way to the end, as we've done in so many other campaigns.
Well, you've sort of you're the one who dragged it out in a public forum. I'm wondering why you did that now. Is it because the discussions that the company said you had already engaged in, for all intents and purposes, went nowhere, and they weren't going to give you what you wanted?
That's right. We just got to a point where I think they had their heads in the sand. I don't think they were, terribly cognizant of what their, what their side of the argument looked like and how poor we thought those arguments were. And I think they were just really unwilling to budge. And we said, look, it's time to let the shareholders weigh in. Let's take this to the court of public opinion and let your shareholders understand what we think the problem is, and that we have an excellent solution, an excellent slate, an excellent plan to unlock value. I know we've talked a lot about the real estate, but there's a tremendous amount of trapped value on the balance sheet that we think can create shareholder value. So I think what you're seeing in the stock price today are people really responding to what we put forth, that this is an excellent plan, an excellent slate, a very qualified group of people that have had past successes in retail that are really here to help and make this a great company.
Yep. Sort of no disrespect in any way to Kohl's management or to your outlook for what the company can be. But what about somebody sitting there who says maybe it's not fixable? Lampert, he's smart. He thought Sears was fixable. Not. Ackman, he's smart. He thought Penny's was fixable. Not. So maybe this is one of those.
Yeah, Scott, we don't see it that way, obviously. We look back over the last decade, there's been a significant numbers of fantastic retail turnarounds, like Best Buy, like Target, like Bed Bath & Beyond. City Trends is another one we were involved in. Big Lots is another one we were involved in. And we really do think that retailers can be fixed. There's so many companies that have weathered this storm and, what's happening in e-com and omni-channel and have performed phenomenally well and taken share in this environment. And we think Kohl's has the opportunity to do that. Remember, Kohl's is one of the few department stores that is off mall. And the convenience factor that was important pre-COVID is even more important today. They can do curbside pickup, buy online, pickup in store. We think they're very well positioned. So we actually see a very bright future for this company with the right leadership, the right governance, the right oversight of the management team.